Imagine waking up 3 years from now and realizing the biggest wealth-building window of the decade came and went, and you did nothing. Not because you were lazy, not because you weren't smart enough, but because fear made you wait. That's exactly what happens to most people every single cycle. When the economy gets shaky, people panic. They stop investing. They hold cash. They tell themselves they'll start when things feel safer. But here's the part most people never understand. The moments that feel the most uncertain are often the moments that create the biggest long-term opportunities. Every major crash in modern history has created two types of people. The first group sees falling prices and runs. The second group sees falling prices and starts paying attention. The first group waits for confidence. The second group follows a plan. And years later, the gap between those two groups is massive. In this video, I'm going to show you why this current moment could become one of those defining windows, what's actually happening beneath the scary headlines, and how regular people can quietly use this period to get ahead. Watch this carefully, because the people who understand this now will have a completely different financial future than the people who ignore it. Why most people miss wealth-building opportunities. Let's start with the real reason most people never build wealth. Fear. When markets fall, when the economy slows down, when the headlines scream recession, inflation, layoffs, and uncertainty, the natural human reaction is to pull back. People think, I should wait. Maybe I'll invest later. Let me hold cash until things feel safer. That reaction feels smart in the moment. But historically, it's exactly what keeps people poor. Because by the time things feel safe again, prices have already recovered. The opportunity is gone. This happens every cycle. One of the most eye-opening studies on this came from JP Morgan. They looked at what would happen if someone invested $10,000 in the S&P 500 and simply stayed invested over the long term. From 2003 to 2022, that money would have grown to roughly $64,000. But if you missed just the 10 best market days during that entire 20-year period, your return would be cut by more than half. Think about that. Missing just a handful of days over decades can destroy your long-term results. And here's the important part. Those best days usually happen during the scariest periods. That's why understanding the cycle matters. What created this opportunity? To understand why this matters now, we need to quickly look at what happened over the last few years. In 2020, the world shut down. Businesses closed. Travel stopped. Markets crashed. The S&P 500 fell about 34% in a matter of weeks, one of the fastest crashes ever. Imagine checking your phone and seeing your investments drop every day for a month straight. That kind of fear makes most people quit at exactly the wrong time. To stop the economy from collapsing, central banks and governments flooded the system with money. Interest rates were slashed to nearly zero. Stimulus checks went out. Cheap loans became available. Borrowing exploded. That helped stabilize the economy, but it also created a new problem: inflation. Too much money was chasing too few goods. Prices rose everywhere. Food, housing, energy, transportation, everything got more expensive. So central banks did what they always do when inflation gets too high. They raised interest rates. Fast. From 2022 onward, borrowing became more expensive. That caused stocks to fall, tech companies to get repriced, crypto to crash, and real estate to slow down. And while most people saw chaos, smart investors saw discounts. Because that's what downturns really are. A sale. The biggest mindset shift: price versus value. Think about it like this. Imagine you've wanted to buy a laptop for the last 6 months. You've researched it, you know it's high quality, and then one day the price drops by 40%. Would you panic because it's cheaper? Of course not. You'd probably feel lucky. Or imagine a house in a neighborhood you love suddenly becomes affordable because everyone else is scared. That fear from other people could become your opportunity. That's how wealthy people think about downturns. When markets fall, good businesses often become cheaper for reasons that have nothing to do with their long-term value. Fear spreads, people sell everything, and prices disconnect from reality. That creates opportunity. Warren Buffett said it best: be fearful when others are greedy, and greedy when others are fearful. That sounds simple, but almost nobody follows it. Because when things feel uncertain, Acting rationally is hard, but that's exactly when wealth is built. Opportunity 1. The stock market. The first major opportunity right now is the stock market. After the bubble years, many stocks have come back to more reasonable valuations. Not everything is cheap, but strong businesses with real earnings, real customers, and real cash flow are far more attractive than they were during the hype years. And the best strategy for most people is not trying to predict the perfect bottom. It's consistency. This is where dollar-cost averaging becomes powerful. Instead of trying to guess when to buy, you invest a fixed amount every month. That could be $100, $300, or $500. Some months you buy high, some months you buy low. But over time, you smooth out volatility and capture long-term growth. This works because time matters more than timing. The earlier you start, the more powerful compounding becomes. Someone who starts today with a simple monthly investing plan is giving themselves a huge advantage over someone who waits until everything feels comfortable. Opportunity 2. Real estate. The second opportunity is real estate. This market is more complicated, but there's still a setup happening. Mortgage rates are high. That has scared many buyers away. Transactions are slower. Some sellers are stuck. Demand has cooled. But here's what history tells us. High-rate environments don't last forever. Eventually, rates come down. And when they do, all the buyers waiting on the sidelines usually rush back in. That creates competition and pushes prices higher. So the people who are able to make smart, disciplined real estate decisions now, without over-leveraging, could benefit later. This doesn't mean rushing out to buy something you can't afford. It means understanding that difficult markets often create the best long-term setups. Opportunity 3. Your skills and income. This is the most underrated wealth-building opportunity of all. Yourself. Your income is your engine. The more you earn, the more you can save. The more you save, the more you can invest. The more you invest, the faster wealth compounds. In uncertain economies, people with valuable skills win. Sales, marketing, content creation, AI tools, coding, operations, communication. The people who solve problems and create value tend to keep getting opportunities. That's why investing in your skills right now could have a higher return than almost anything else. A better skill can increase your income for decades. That extra income becomes the fuel for everything else. What smart people actually do. So what do people who consistently build wealth actually do differently? First, they automate. They don't rely on motivation. They set up systems. Money gets invested automatically every month before they have the chance to spend it. Second, they ignore noise. They don't let headlines control their decisions. They understand that short-term fear is normal. Third, they think in years, not weeks. Most people want results fast. Wealth doesn't work like that. Wealth is boring. It's consistency repeated for years. Fourth, they start before they feel ready. This is huge. Most people wait for the perfect time. Perfect income, perfect market, perfect confidence. That time never comes. The people who win usually just start small and improve over time. The real battle is psychological. Here's the truth. Nobody talks about enough. Building wealth during uncertain times is more psychological than financial. Your brain hates uncertainty. When prices fall, your brain sees danger. This is called loss aversion. Humans feel losses more intensely than gains. So when your portfolio drops, your instinct is to run. But the people who build wealth are not fearless. They just have systems that protect them from emotional decisions. That's why automation matters. That's why long-term thinking matters. That's why having a plan matters. You need a strategy that still works even when you feel uncomfortable, because discomfort is usually part of the process. Final message. This window won't stay open forever. Here's the bottom line. We are living through a financial reset. Higher rates, market corrections, and uncertainty have created a moment where assets are more fairly priced than they've been in years. That doesn't mean everything is cheap, and it doesn't mean there's no risk. But it does mean that the people who stay calm, stay consistent, and keep building now are putting themselves in a powerful position for the next decade. The biggest mistake you can make is waiting until everything feels safe. Because when it feels safe, the opportunity is usually already gone. You do not need to be rich to start. You do not need to be perfect. You do not need to time the market. You just need to start. Start learning. Start saving. Start building. Because this could be one of those rare windows that changes your financial future, but only if you move while it's still open. If this helped you, subscribe and check out the next video. And as always, this is not financial advice, just education to help you think smarter about money.